Gold stocks have sold off about 40% from their April high. This is a result of the fact that the market has concluded that inflation is going to be tamed. It's going to come down from its 9% back down to its 2 to 3% objective by the Fed, and that quantitative tightening could push the economy into recession, which would also help dampen inflation fears. I think this opportunity with regard to gold stocks is extremely attractive. The stocks have never been cheaper as far as cash flow, earnings per share, dividend yield, making them very good investments from a valuation standpoint. As we all know, the gold stocks and their performance is going to be tied to gold. And gold has actually held up much better than the stocks, allowing their earnings and the cash flow to keep coming in, even though it's coming in a little lower than people would have anticipated at the beginning of the year. As we move into this new domain of quantitative tightening, the real question is going to be how fast are they going to do this quantitative tightening, and are they going to do enough quantitative tightening to actually reverse the inflationary pressures that are already built into the system. Please remember, the Federal Reserve raised its balance sheet from $800 billion in 2008 to $8.9 trillion, 11 times increase over the past 13, 14 years. So we have a situation where you have all these inflationary pressures, all this extra cash sloshing around the system. It has gone into stocks, it's gone into real estate, it's gone into cryptocurrencies, and it did not go into the gold market as one would have anticipated historically. The other element to keep in mind that's a positive for gold is that the countries of Russia and China are beginning to utilize more gold in the reserves, less US dollar. This should also be a favorable outcome for gold pricing in US dollars over time. So we do think that these stocks are attractive, that gold is relatively attractive here, and as deep value stocks with low valuations, we really do think that there's some opportunities here. One of our favorites is Gold Fields. The company has a 3.6% dividend yield, is in the midst of taking over Yamana, and the stock sold off with regard to that takeover because Gold Fields is paying a premium for Yamana. This means that you are getting a little extra value, about 10% extra, if you buy the Yamana AUY as opposed to the Gold Fields GFI. You will not be getting a dividend until the transaction is consummated, or not be getting a very good dividend, but you'll have to wait on the dividend, but you do pick up about 10 percentage points extra if the deal is consummated, and you'll get Gold Fields shares at that time with extra value. So that's an interesting way to play it, either directly with the Gold Fields if you want the dividend yield today, or with the Yamana. In addition to that, we like BTG. We do think that that company also has a nice yield, very undervalued. It's a mid-cap stock. It's a little under the radar screen. Here again, it does pay a nice yield, over 4% yield. So this is something that I own in my own portfolio that I suggest you take a look at and see if the risk profile fits your needs. This is Benjamin C. Halliburton. This is buildingbenjamins.com. Please take a look at our full disclaimer on our website, where we explain that this is strictly what I'm doing for my own portfolio and not investment advice. We do not know your particular situation or risk profile. Please also take a look at buildingbenjamins.com to sign up for our emails so you'll get these videos and our written reports in a very timely fashion. We hope you find this helpful and have a great day. Thank you.